Welcome back from break, everyone. It's now my pleasure to introduce our moderator, Jim Coburn, Senior Manager of Disclosure for Ceres, Nina Chen, Director of Sustainability and Climate Initiatives for the New York State Department of Financial Services, Marissa Lefebvre, Senior ESG Research Analyst for Parnassus, and my good friend and past head of the Council on Environmental Quality during the Clinton-Gore administration, Katie McGinty, who's now Vice President and Chief Sustainability, Government, and Regulatory Affairs Officer for Johnson Controls. They'll explore the link between climate risk disclosure and risk management from the perspective of investors, companies, and regulators. They'll also discuss how climate change affects both the investment process and prudential regulation. I'm really looking forward to this session now, so let's get started.
Great. Thank you so much, Dawn. And thank you very much, Marissa, Nina, Katie, for joining us. I'm excited to get three different perspectives on these issues here. We're going to look at climate change from the Ceres lens of improving investor and business practices and policy. We'll focus not on the mechanics of disclosure, but why climate disclosure and risk management matter to regulators, companies, and investors. Let's start with a foundational question of why is climate change important to your organization? Nina, could you start us off?
Hello, everyone. Thank you so much for giving me the opportunity to speak to your joining this panel. Before I start, maybe I could say a few words about the DFS, since probably not everyone in the audience knows who we are. So we're the New York State Department of Financial Services. We're the state regulator, and we regulate and supervise about 1,800 insurance companies with about $4.7 trillion in assets, and about 1,500 banking institutions with about $2.6 trillion in assets. So DFS views climate change as posing a material risk to the financial system. Therefore, it's fully within our jurisdiction to ensure that our institutions are prepared to manage the financial risk from climate change. This is part of our safety and soundness work. Our superintendent, Linda Lacewell, visited Europe in 2019 and spoke to Bank of England, Banque de France, and several other international regulators, and realized that the US was very far behind in terms of climate-related financial supervision. At the time, the federal government was rolling back climate policy, and our superintendent felt that the states need to take the leadership role in this crucial issue. So that was why DFS joined the Network for Greening the Financial System, NGFS, in 2019. It's a network of central banks and supervisors working on climate and environmental related risks. DFS was the first US financial regulator, state or federal, to join NGFS, and the Fed joined last December.
Great, thank you, Nina. Appreciate that. And Katie, can you weigh in with your perspective on why climate is important to Johnson Controls?
You bet, Jim, and thank you again for including me. And I really want to start just with a shout out to Ceres. Ceres has been on the front of this issue, the critical linkage between climate and the financial system for a long time, and you've made a very important positive difference. So thank you, and thanks for including me today. So we start at Johnson Controls with a pretty simple proposition as to why we care about climate change. And that is that we kind of think a functional planet is important to a functional economy and company. I'm reminded of the economist Herman Daly, who famously said that the economy is a wholly owned subsidiary of the environment. Bringing it a little closer home to Johnson Controls. So we are a pure play sustainable buildings company. Now, the reason why climate is so important to us brings up some good news and some bad news. I'll start with the bad news. The bad news is that buildings where we live and work, what Johnson Controls is about, represent about 40% of global greenhouse gas emissions. COVID showed us that the situation is even more challenging. When we had buildings with 80% plus reductions in occupants, what we experienced was less than 20% reduction in the energy consumption in those buildings nonetheless. And the reason for that is because, no offense, but most buildings are dumb. They are either on or they are off. Texas shows us it's not a good idea when those systems go off, water pipes burst, etc. So that brings us to the good news. And the good news is all of that is avoidable, because when you drive highly efficient building technology, and now you add digital platforms to that, ours is called Open Blue, open architecture platforms that connect operating technology with information technology, we are realizing more than 50% reductions in energy and carbon and in costs, and making buildings a grid stabilizing asset instead of a grid crashing liability. So climate it is our building, it is our purpose, it's what we're about. And our mission and our mantra is to, in the pantheon of stuff we care about as essential climate tools, solar, wind, EVs, and smart buildings. So it's pretty important to what we do, Jim.
Good. It sounds truly integrated in all of your work. Let me move to Marissa. Can you tell me about Parnassus and how you view climate change?
Yeah, absolutely. Thanks, Jim, and thanks everyone for having me. So, Parnassus Investments, we are a mutual fund company, and we have 5 full pure play ESG mutual funds, all of which are actively managed. So what it comes down to for us is that climate change is important because it is fundamental and a systemic risk that will affect not only every single company in our funds, but literally every single company in the world in some way. We know that no company can escape the impacts of climate change. And we know that for many of them, the impacts will be material, either directly to their operations or to their supply chains, or for some, even the viability of their core business models. And so for us as long-term investors and as ESG investors, it's incredibly important for us to understand the impacts of climate change individually on companies that we choose to invest in, but also across our portfolio so that we can make informed decisions and invest accordingly. So I'd say the 2 most prominent ways that we currently integrate climate change and climate risk into our investment process is 1, by extending our fossil fuel exclusionary screen across all 5 of our funds, which we did in 2019. And 2, by building climate risk and environmental impact into all of our sector risk frameworks, which we use to evaluate whether a company meets our fund's ESG criteria, and thus we are able to invest in them. So in short, very simply, climate change and its impacts are undeniable, as Ceres and all of you know. And so we as investors need to understand that.
Good. Thank you, Marissa. Let's go into risk management in a little more depth, because that is a topic that's gotten a lot more attention, how climate fits into existing frameworks. So to start with you again, Nina, how do you view climate as part of enterprise risk management?
Yeah, thank you for the question. So we think climate change should be an integral part of enterprise risk management. So last year, we issued the guidance to both insurers and banks, expecting them to integrate the consideration of financial risk from climate change into their governance, business strategies, and risk management, and also start developing a disclosure framework. I think for the governance framework and the risk management process that institutions currently already have to manage other risks can be applied to manage climate risk. You should start from the top on governance. Do you have the board or committee of the board be responsible for climate risk? Do you have the appropriate senior management function to be responsible? It shouldn't be just part of the corporate sustainability or public relationship departments, but ideally be part of the risk and the investment departments and others as well. We're writing a detailed guidance on insurers, on how insurers should manage climate risk, and it will be exposed to for public comment in the coming weeks. You will see that in the guidance, we cite New York insurance law, the NAIC Financial Condition Examiners Handbook, the ORSA manual, as well as international regulators' guidance. think this is a good news in the sense that the existing risk management systems and functions and roles can be applied to manage climate risk. And at the same time, we do recognize that this does managing climate risk does require new expertise and new knowledge. And I would say that we have been taking a very collaborative approach in developing our climate program. And we recognize that properly managed climate risk is a journey, and different institutions are at very different points on this journey and have different resources. And so we want to be supportive of our institutions in this. On the insurance side, we have organized a series of seminars where we invite insurers to share what they are already doing on risk management, investment, setting metrics and targets with their peers. And Ceres was on the risk management and disclosure panel and provided great insights in these topics beyond what's just happening in the insurance sector. We had more than 1,400 participants joining these seminars, and people are asking for more. On the banking side, we realized that it's not all clear to a lot of our smaller institutions how climate change impacts the financial system and them. So for community and the regional banks and for mortgage banking institutions, we held webinars on the fundamentals of climate change and the financial markets. They were also very well received.
Thank you. Thank you, Nina. That's really helpful. I wonder, Katie, if you have reactions to the DFS approach and also any thoughts on enterprise risk management.
Yeah, well, I want to totally subscribe to what Nina has laid out and very clearly. So thank you, Nina, very much on two scores. One is that climate can and should be a seamless, important, integrated piece of an enterprise risk management system. And the second very important piece, I think that Nina said, as you engage in doing that, new and additional expertise and insight needed there. So to share our experience, we do have climate as an integral piece of our ERM process. The new and additional expertise we bring about through our thoroughgoing scenario analyses that we do pursuant to CDP. And we lift up some of the both risk and mitigation, both opportunities and options, and pull them in centrally to our ERM. And I just say, here's what we certainly have found and have shared. There billions of dollars can swing here if you have a climate risk that is unmitigated. And that risk is both in terms of physical impact as well as transitional. So physical impact if all your plants are in floodplains, for example, your supply chain might be vulnerable, for example. And then the mitigation, the transition pieces of it. If you're a company that is on your back foot, not anticipating, for us, it's about energy efficiency requirements and regulations for building technology. And we're an oddball company that lobbies for regulations. We want them to be tighter. Or the transition to new and cleaner refrigerants. So whatever the equivalent is in your industry, that's a second kind of risk, Jim, which the physical, but then the transitional is not to be on the back foot. But I also want to send, I think, an important and encouraging message, a kind of be not afraid to cut carbon, because certainly what we have found, and we're a net zero committed company, on the path with science-based target approved journey, absolute emission reductions. And our experience in putting the game plan together and executing is that from an operational point of view, an energy point of view, and a materials point of view, we are realizing significant savings, millions and millions of dollars, as we move to that 100% renewable globally, as we are moving and have moved to better refrigerants, and as we transition our fleet to much more efficient and then to electric vehicles. And lastly, I'll just say is we have seen the significance of all of this so much that we hardwire it now. So more than 75% of all of our R&D and new products has to pass a climate sustainability screen. And now we have a screen for every capital investment the company makes, again, has to contribute to sustainability and cutting carbon.
Great. Thank you, Katie. That's a lot. There's a lot there. It's really interesting. I want to ask Marissa about enterprise risk management. I know Parnassus has changed some of the companies you invest in, and it would be great to hear how you view companies in different sectors.
Yeah, so the way that companies treat climate risk to me really shows me how seriously they're taking it and how prepared they are for it. Clearly, Katie and Johnson Controls have it down. But when a company builds climate risk into the broader fabric of their risk management program, it communicates to me three main things. First off, that they understand that climate risk is an enterprise level risk, not just one that will affect a single business unit or a single product line. But second, it communicates that they also have a formalized assessment process, oversight structure, accountability structure around climate, which is incredibly important. And third, it really communicates to me that they seek to understand the holistic impacts of climate change on their business. And what I mean by that is, companies often, and we as investors as well, are prone to thinking about climate risk as an E of the ESG issue, just an environmental issue, when in fact it's all three, E, S, and G. And Katie, you touched on this a bit, but climate is obviously essential to the environmental story. Topics like greenhouse gas emissions and physical asset risk and water availability are really all important to understand. But climate is also an S, or a social conversation, in that thinking about the just transition and the impact that climate change will have on a company's employees, on their customers, on the communities in which they operate. It's all important because those people's safety and their financial stability, their health, and even their ways of thinking and behavior will change drastically. And lastly, it is a governance, a G conversation as well, because how a company's leadership plans for and responds to a risk as significant as climate change, to me, is a reflection of their capacity for long-term thinking and planning, and really gives me an eye into that leadership's ability to sustain and grow the company well into the future, which of course is important to us as investors. So I can't possibly determine myself every single way that climate change will present risks and opportunities to every company we invest in, especially because it varies so much across sectors and even individual companies. And that's why it's so important to us that companies really take it seriously, really treat climate as an enterprise risk, and view it beyond the confines of just an environmental problem. So that, because only that way, only when they think of it that way, can they be prepared for it, and can we be comfortable that they're properly preparing for it, and thus be comfortable in investing in them.
Great, thank you, Marissa. It's similar to how I think about disclosure sometimes, in that it's not just disclosure for disclosure's sake, but how it affects the company internally and investors and stakeholders. So that's interesting. I'm going to move to disclosure now. I want to ask you, starting again with you, Marissa, what do you think about the current state of disclosure that you see from companies? Is it sufficient? And if not, do you have any thoughts on how to improve the information?
Yeah, I would say the short answer to that is no. Unfortunately, it's not yet sufficient. It is for some companies, but it's definitely not for all. And part of the problem is that ESG disclosure and climate disclosure, as it stands in the US right now, it's voluntary, and thus it's really largely up for interpretation by the company, kind of cherry picking what they do and don't want to talk about. And what we see from that are wildly different levels and types of reporting across companies. So in the same exact sector, you might see one company that has science-based targets and a beautiful TCFD report, and then another company that mentions climate risk only once in the risk section of their 10K. And this gives us an idea of which companies are leading, or maybe even more importantly, it gives us an idea of which companies have the most resources and time to put toward ESG disclosure. But it really doesn't give us a lot of insight into the rest of the companies. And so I think, broadly, I'd like to see a minimum level of required ESG disclosure for all publicly traded companies, regardless of size. that would help greatly. I'd also like to see the coalescing of all of the great frameworks and standards that are out there right now into a single standardized auditable framework, so that we can compare across companies. And more specifically on climate, I'd really like to see the normalization of full emissions disclosure, so scopes 1, 2, and 3, as well as science-based targets, and maybe equally, if not more importantly, detailed and thoughtful action plans on how to reach those targets and all other goals that companies set, so that we're not working off of empty commitments that are 20, 30 years in advance.
Thank you. That's helpful. It makes me think that, we need obviously different regulators, not just the SEC, working on this, because there's a range of information to be disclosed. Let me turn to you, Nina, with your thoughts on disclosure. Is it sufficient?
Yeah, thank you for the question. And I really appreciate Marissa's comment. I'm really glad to see that investors are demanding this. I think we need all the stakeholders out there to demand more transparency. And on the disclosure side, in our circular letter to insurers and the industry letter to banks that I mentioned earlier, we asked our institutions to start developing a disclosure approach on their financial risk from climate change, not just operational, but really the financial risk from climate change. And we did reference the Task Force of Climate-Related Financial Disclosure, TCFD. We see that TCFD has become the gold standard for both many international regulators and also companies. The UK and the New Zealand have mandated TCFD disclosure for their financial institutions and the listed companies. More than 1,500 organizations have endorsed the TCFD according to its 2020 status report. And I will also echo with what Marissa said, that despite a lot of endorsement, there is a wide range of sophistication and the kind of information included even in the TCFD report. And what we like about TCFD is, besides serving as a disclosure framework, it can also serve as a framework to think about how companies manage the climate risk and taking advantage of the climate-related opportunities. We have heard from institutions that have released the disclosure reports according to the TCFD framework, that it had helped them sharpen their approach to managing climate risk and taking advantage of the opportunities. DFS is also an active member of the Climate and Resiliency Task Force at the National Association of Insurance Commissioners. 6 states within the association, New York included, have been asking their large insurers to respond to the climate risk disclosure survey for the past 10 years. In the past 2 years, we have allowed the TCFD reports to be submitted in lieu of responding to the survey. And there is a solvency work stream on how to improve the survey. We have spoken to the industry, academia, and other stakeholders on this. Some of the suggestions brought up include, can we make the disclosure more relevant for insurance while following the TCFD framework? Can we make the response easier for users to analyze? I know right now, reading TCFD report or reading a lot of the responses to the NAIC, National Association of Insurance Commissioners, climate risk disclosure surveys, like reading novels. It's a volume, pages and pages of descriptive text with some numbers. And it would be great if we have more standards and make it easier to compare across the industry as well as within industry across companies. I know there is a lot of effort to create consistency for disclosure, such as the International Financial Reporting Standard Foundation, and we're very happy to see that this is happening.
Great, thank you, Nina. There's a lot there. Let me ask Katie to start with what kind of disclosure you think about internally at Johnson Controls, and what do you think about the field in general?
Yeah, so first I want to subscribe to what Marissa and Nina both said. I very much agree. We are disclosers from way back. So we've been reporting since 2002, I think. Let me share a particular lens on this, if I could, and it comes from a slice of the overall greening of the capital markets And some of our experience in being one of the first industrials in the United States to float a green bond and one of the first to float a sustainability linked bond. Now, what we did was a very rigorous, again, thoroughgoing review of what would constitute green in terms of where those dollars from those financial instruments would go. That process, we then took external to Sustainalytics for third-party review, and they reviewed it thoroughly. Their review and our resulting green finance framework is all out there publicly, and I do encourage people to look at it because it's a significant undertaking, but it's there now for reference so that others can go out and build this green capital market in the US like we have seen flourish in Europe. But coming back to disclosure, it's really critical to this point. We know to get ahead of climate change, we need to mobilize $3-4 trillion of additional green investments every year. Our experience with our green bond says that, and Marissa's the expert here, but that there's huge investor appetite. Our green bond was 9x oversubscribed. The hesitation, though, is that investors need much more reliable disclosure and consistent and auditable and comparable across industries as to what constitutes green, what really constitutes managing and hitting a carbon risk. So the movement towards mandating disclosure, systematizing disclosure, we feel is one of the essential pieces to unlocking that private sector capital that's needed. But the last point I would just make is, as the SEC in particular embraces this, there's cacophony out there. So I would just say more is not necessarily more. Less is more if quality is king. The data is real, it is transparent, it's auditable, and it genuinely reveals the risks at hand. So we're all for it, and we hope we can do the thoughtful process like New York has done to really get it right.
Great, thank you. I know we're running pretty short on time, but I'd actually like to ask Marissa or all the speakers, is there anything you'd say on auditing that hasn't been said before that you think is important to climate risk? Marissa?
Yeah, I'll try to keep this brief. I mean, auditing is important because it ensures that the information that's being shared is truthful, but I would hope that most companies share truthful information anyway. The key reason why I think auditing matters is actually how it elevates the importance of that information to the company itself. If they have to get that information audited, they need to take it very seriously. They need to make sure that, they have all of the processes in place and that, they're looking at that information and making sure as much as they can put out is out there as possible because it's being audited. So that's my thought on that. Auditing is really important, and I do think it should be built into whatever structures, pan out.
And Katie or Nina, do you have any thoughts?
I, again, subscribe to what Marissa said. I think this is an emerging field. So far, we do have our data audited. I think it is good that some of the auditing majors now are also getting into this space. And I think that will expand the reach and the depth of the reviews that are available out there.
Great, thank you. I really appreciate it. It's been a short amount of time. I hope we can continue the conversation, but I want to thank our speakers, Nina, Marissa, and Katie. I found it really helpful. So again, thank you all for speaking about your work. I really appreciate it.
Thanks for having us.
Yeah, thank you.